Gives me great pleasure now to bring on board PB Balaji of Tata Motors. And before I introduce him, I just want to put things into context here. If one really examines the history of corporate India, one company which can really be credited for turnaround in last couple of years is Tata Motors. From high debt to low sales to a comeback on debt, complete commanding market share in the Indian PV EV market, and a big turnaround when it comes to their financial as well as operating leverage. Tata Motors has demonstrated that they've got it all when it comes to execution, understanding of consumer, and also understanding the financial metrics. So PB Balaji and his team, in a sense, can really be credited for that extraordinary turnaround which has been in a sense implemented in last couple of years. Balaji, so nice to have you back on ET Now. Thank you for joining us. So what shall we start with? The hot topic, which is tariffs and FTA, numbers for the quarter gone by, or when the demerger of Tata Motors will happen?
Thanks, Nikon. Thanks for having me on the show. You go with it, whatever you prefer. Let's start with that.
Quarter gone by, good numbers. But the guidance for the coming quarter is not in sync with what you've actually delivered for the quarter gone by. So why, after a strong quarter, you are sounding slightly cautious and careful and not ready to commit?
Few things, Nikunj. I think one is we have a track record of doing what we say, and therefore we would prefer to stick to that. Second, we also have to be careful in terms of understanding there's just too many moving parts in the external environment. The tariffs in the US is something where the UK and US have struck a deal, but the fine print is still not clear. There's still a lot of details awaited in terms of whether those tariffs are now waived for parts and accessories. Is it available from a retrospective effect from April 3rd when the tariffs first came on board? How exactly is going to get implemented is unclear. So I think until we get further details on that, it's going to be very difficult. And these are all, every day is a cost that you would have. And therefore, it's important that we get a hang of what those dates are. And the numbers can move materially, so we would rather wait for that before we put it out. Second factor, I think, similarly, we need to see a tariff deal happening between EU as well as US. EU-US deal as well, because you've got our defenders and discoveries being made there in the Slovakia plant. So that's why I'm hopeful that will also come through. So I think there's a lot of moving parts as far as JLR is concerned. Domestically, I think things are much more stable compared to what we see in the international markets. And therefore, we'd prefer to take a longer-term view of that. And this year, if you notice, commercial vehicle we have delivered, despite a decline in revenues, we held our shares and at the same time improved our profitability. And that journey will continue. We would want to see us stepping up on the market shares as well, particularly in the small commercial vehicle business. But that's the only area where we should have done a better job than what we have done last year. So with that, I think the commercial vehicle business will be on a fine fettle as well. And on the passenger vehicle side, I think this is a year of consolidation and our market shares have stabilized. Our product offensive starts now with the launch of the Harrier EV. Then we have the Sierra coming in. The Altroz has just been relaunched. The Punch mid-cycle refresh is coming through. So a lot of product actions are coming through. And that should also help us get back to the share increase journey that we've been on to for the last 4 years. So it's quite a full plate that we have. So the actions are all happening. But to translate that into numbers, and this is what will be the numbers here, it's just that the externalities are simply too confusing for us at this point in time to be able to distill it out and hold ourselves accountable to that. But the fact that we'll focus on growth, the fact that we'll focus on investment, that doesn't change. And that means we'll need to be very tight on our cost, very tight on our cash. And that is something we'll do.
So one has to understand the current US business for JLR. Where does it stand? Because I distinctly remember a announcement from the company where they decided to halt the JLR production, that you've resumed operation. So where do we stand there? Are inventories getting piled up? Is demand dropping down? Where is the demand standing for US JLR products? And where do you stand in terms of inventories there?
Yeah. So 30% of our volumes come out of the US, and it's a very strong market for us. And with respect to we had decided to pause the dispatches from UK into US in the early part of April because we are awaiting clarity on the tariffs, and we have recommenced our dispatches 2 weeks back, and now we have the UK-US tariff agreement also happening, and therefore for us it is, from a production perspective, it is business as usual, and we would expect to catch up on those lost dispatches in the coming weeks. In terms of demand at this point in time, no major change in the demand environment there at this point in time. The new prices will be going in soon, and that is when we'll be in a position to read the demand situation better. Having said that, given it's in the premium luxury segment, I do expect the demand to be far more resilient compared to a more mass kind of manufacturing OEM, and therefore I remain optimistic on the demand even in the US.
And Balaji, I'm just sharing this for the benefit of our viewers that JLR accounts for more than 70% of the total business for Tata Motors, and what we've discussed about US is only 30% of the total business. Since JLR is still the big moving part for Tata Motors, let's discuss the 70%. You've told us the 30%. If the 70% business, which is the non-US business, how is that shaping up? Where do you stand on that, and do you see visible growth in that 70%?
Yeah. I think where we are seeing a good rebound happening is in the UK business, which is almost 20% of JLR. Then where we are seeing a lot of stabilization starting to happen and a little bit of growth coming through is also Europe, which is 20-25% of our volumes. China is an area where we've been concerned for the past year, but it's fair to say China is now more or less stabilized, albeit at lower levels. And the rest of the world has been doing well for us, and that continues to do well. And with the new launches happening, including the Defender Octa, we do see good momentum coming up in the Middle East and markets like India, which are also doing well for JLR. So if I were to rank order them, I see opportunities in the rest of the world, in UK, Europe, and we should be able to hold China, which will be a far better performance than most of our competitors in terms of our delivery. We are amongst the very few OEMs which have actually delivered on our guidance this year. And that should tell you that the portfolio is in a strong wicket, the business model is working well for us, and hence the confidence that the underlying fundamentals are fine.
Just a follow-up question on China and US both put together. So that's 50% broadly. And if 50%, one part is uncertain, which is US part, China is under pressure because of competitive pressure. So can I say for JLR, 50% of the business is under pressure? I'm just stitching some words together here.
See, the market may be under pressure, but our performance has been pretty good in these markets, both China and in US. So at the same time, the product launches are doing well for us. So we do believe that there will be a resilient performance in the overall JLR, where whatever volume shortages that we would probably expect to see in US, we are able to make it up with other markets. But yes, at an overall level, it is fair to say that demand could come under pressure. And that's the reason we have said, okay, if demand comes under pressure, our job is to ensure that the cost side of it is something we do a very good job of and keep it really tight, so that the overall profitability is something that we are able to manage well. And this is no different from the rest of the automotive world, and we believe we are much better off compared to most other OEMs in the market, both in terms of relative performance as well as overall track record of delivery this year, both ways.
And both relative and absolute, I think, has been fantastic for JLR. So I'm going to focus on other aspect, which is the debt. It's just been a fantastic success story where debt was versus where it is right now. And you will be able to replace your debt because JLR margins were able to recover. But given that things may be slightly uncertain there, and as you expand into the future, what are the chances that you actually would be increasing your debt levels because of pressure and because of capex plans?
Yeah, great question. If you notice, what we have specifically guided for is that the investments of JLR will continue apace. We don't intend to change the investment plan because of the current temporary issues that we see in the demand side of the equation. At the same time, these investments will be funded purely from operating cash flows. And that is something we are confident of, and we are absolutely clear that is how we'll do it, so that JLR will not be getting into a debt situation because of investments. Working capital noise will keep going up and down, very difficult to predict, so that's the reason we kept it out of the equation at this point in time. But as long as the business is funding its capex out of operating cash flows, it's living within its means. and therefore we do not expect debt levels to increase here on, and once the situation normalizes, we should start becoming significantly more cash positive in our overall situation. So if I look at the post the demerger, there will be a CV business and a PV business. I think at a PV business, we will continue to remain net cash, that is JLR and domestic PV together, and CV business will also be net cash, and therefore both businesses will be, post the demerger, will remain in a very strong balance sheet position.
Just to understand one more aspect, it's not a sizable business for JLR, but the India business. Now, there is clarity at least on the FTA front between India and UK. How will life change for you in India, and especially for JLR products in India?
Yeah, I think firstly we welcome this FTA because it gives us significant operational flexibility as to how we plan between UK and India. Firstly, I think the current products that are there in the market already for JLR, be it especially the Range Rover franchise, the Range Rover Sport, the Velar, the Evoque, all these are locally CKD manufactured, and therefore those will not be impacted by the current FTA that has been signed. At the same time, products like Defender are coming out of Slovakia, where in any case it's directly imported, and we do not, that the FTA is not relevant for that. Where this really starts becoming interesting is for the future products that will get introduced in JLR, because then we will be able to access these global products at global prices straight away. But I think we've got a few more bends in the road that we need to turn. Number one, we need to understand what's the time frame for this. The details are not there yet. And secondly, what are the quotas we are talking about? That also we need to understand. But directionally, this is the right thing. Directionally, we quite like what is happening. And flip side also, what's going from India to JLR UK also is something, there are opportunities that we would want to consider, be it on the Agratas battery side. Does that come into this? We need to understand. So those are multiple moving parts there, but it's a great development. And I think once we have better details on that, we'll be in a position to plan our supply chains much better, and we look forward to that.
So we've discussed the demand scenario, we've discussed financials. I'll now talk about the product cycle and new launches, and I'll start with JLR. While it is referred as JLR, large part of expansion and new product launches is still happening in the R part. If I say that most of the Jaguar products are reaching the end of their life cycle and you are not looking at investing there, looking at what we understand from the market, will my assessment be right?
Yeah, see, we have confirmed that Jag as a brand goes fully electric from 2026 onwards, and therefore that is a key shift that we are doing in the portfolio. So this year the entire Jag models run out, and thereafter the new Jaguar, which is in the electric form, lands up. You saw the Type 00 being revealed last week back. It was in Monaco, and soon it will be coming into Mumbai as well. So that, and there are almost 32,000 expressions of interest that are coming onto that car. And therefore, that is the start of the new journey for Jaguar as a brand. And we are very excited about the kind of excitement that it has created. As far as Range Rover is concerned, I think the full the set of launches, the next big one that's coming through is the Range Rover Electric, and then the Range Rover Sport Electric comes in as well. These are very, very important launches for us because it is targeting a very different customer base to what the current Range Rover customer is. Then is the Defender, where I think the Octa just launches, which has got a rave reviews, and we should soon be seeing it in the Dakar Rally as well. That's another great brand for us to grow from here on. So I think the product pipeline is in the next 3 years is extremely intense in JLR, and we should continue to see the product offensive continuing there as well, which is the reason why the investments are at almost 3.8 billion every year. So that's the entire JLR cycle plan.
Let's talk about India. I mean, again, a great resounding success has been, and quite admirable, that Tata Motors understood the migration in India from ICE to EV, and you have a dominant market share in the EV market. But the EV market in India, by incumbents and by new players, is getting highly competitive. How do you plan to protect the market share, and with this kind of intense competition, where is that market headed for Tata Motors?
Yeah. Firstly, I think we welcome this competitive intensity because that is the starting point of EVs going mainstream. and we'll be the largest full range player in the country, starting from a Tiago at one end, and we go all the way up to an Avinia when it launches next year. So it's a full-fledged product portfolio that we have. And this year we have two additional products landing up, which is the Harrier EV, and we also have the Sierra EV coming as well. So the portfolio intensity is something, the portfolio launch intensity will continue to remain where it is. The thing that has cost us grief last year has been the fleet sales, which has come down quite a bit for various reasons, starting from FAME incentives to some players getting into trouble. And that is something which we are very clear that we'll need to address as we go into this year, and there are action plans underway on that particular front. Additionally, I think the mainstreaming of EVs will also require that the range starts increasing, and that's the reason today you see most of the cars that are coming out of our stable will also start hitting the 400 kilometers plus kind of a range, which reduces range anxiety quite substantially. And the other is the charging infrastructure, where last year cumulatively we have put almost 21,000 fast chargers in the country, and then we are working with charge point operators, integrating them into one app so that we know exactly what is the state of the charger in any location in India. This journey will continue, and as a market leader it's our job to keep driving up the charging infrastructure as well. So we are clear, mainstreaming the EV business is so that it takes over from ICE is our job as Tata Motors, and we will as a market leader we will continue to drive that. As far as competition, market shares are concerned, for me more than market share, what is important is what is the EV penetration in our portfolio, are we getting volume growths in the EV business, and as far as market shares, it will finally lay out as to how much product portfolio that you have, and that is an offensive that we will not shy away from, and we continue to be intensive there. So that's how we are looking at this entire portfolio. Next year is going to be a pivotal year for EV growths. It is also going to be a pivotal year for PV growth, because this has been a year of consolidation, and we would want to now step up the offensive with the product launches happening next year.
Specifically said that JLR as a OEM has done much better than other OEMs globally, and that was a global comparison. In India also, I mean, the PV or industry demand has been flat to moderate. Do you expect that on a blended basis, both ICE as well as EV put together, you will do significantly better than industry average?
Next year, that is the plan, and what is backing that plan up is the product launches. And the second work that we have done a fair amount of work this year is stepping up our service network. That's been our Achilles heel last year, because the product's growth has been so intense in the last 4 years. The service growth has not kept pace with the product growths that have happened, and that did cause a fair amount of angst within our customers. We have addressed that comprehensively last year, and during the first half of this year that will continue to play out, and therefore we would expect to substantially relieve the stress on the service network in the second half of this year. That should also gain us in terms of customer affinity, which should help us grow as well. So both these should play in our favor.
Question of PV market, because you have a dominant market share in the entry level, which is the 12 to 20 lakh entry segment in the EV market. Are you likely to focus on that part, or you would be looking at new step-up launches which could be dramatically different? I mean, are you likely to be moving up or innovating in that sweet spot?
See, we are a full range player, and we do the full options, sedans, hatches, SUVs. We do all powertrains, diesel, petrol, EVs, CNG, the whole lot, and therefore that is how we'll continue to play this game. It is a full portfolio play that we do. And if you look at the current year that went by, I think from a growth perspective, our SUV portfolio did far better than the market. Where we did have a challenge is on the hatches portfolio, particularly at the lower end, and that is the one that cost us overall stress in the market. But with the launch of the Tiago that has just happened in February, and Altroz that just happened a few days back, we believe the hatch segment is something again will start getting competitive this year. So we are focused on the full portfolio, and that's how we would like to grow that.
I've got so many questions for you. What a very extended, and a packed up day ahead. So really appreciate your time, and I certainly look forward to much more engaging discussions. We rarely get a chance to talk to you. I have to jog my memory to remember when was it last. I think it was a while ago. So would request you to see, give us more time and perhaps more interactions in future.
Thank you, Nikunj. Nice speaking to you. All the best.
All right, so that was the management of Tata